Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Happy Friday, Bob.
Well, we got a headline here that really got my attention, and it's "The Black Hole Engulfing the World's Bond Markets." And then the next part of that headline was "Negative Yielding Debt." And this is where, and mainly in Europe, the pressure on interest rates has been such that if you lend somebody some money, you get back less than what you lent. And that's not just through depreciation, it's negative interest rate, which is really quite remarkable, and it shows how artificial the concept of intrusive central banking is. Because they've got this theory that if they push credit into the economy, it makes the economy go. And it's just a wild idea that it really doesn't happen at all. But when credit conditions are easy, speculators will find something to speculate in.
Well, Bob, I believe we even have a question from our good friend Frank de Beer in Belgium that's all about that. We might as well take a look.
Read the question and we'll continue on.
Sure. The global economy, his question, Bob. The global economy runs on 5,000-year lows of interest rates. Europe has negative yields on 30% of investment-grade bonds, 14 junk bonds, and the majority of government bonds. Yet our new European Central Bank chairwoman, Christine Lagarde, advocates more easing, more stimulus. This is not crazy anymore. This is totally absurd. If a real post-bubble contraction clears these excesses, and that is what post-bubble contractions are supposed to do, are we not looking at something far worse than 2008?
Oh, yeah, Frank, that's a good one. And as I was saying, it's a wrong theory. They've looked at a business cycle. You get a business expansion, and with that, credit expands. But these idiots in economics and central banking, they looked at it and made the classic error that credit expansion forces business expansion, and that's what's called in logic a primitive syllogism. And the oldest example, of course, is that sunrise, the rooster crows, and that forces the sun to come up. So a whole lot, or one of the foundations of intrusive central banking is a complete error. So what happens, and they think that when you push out credit, it prompts business activity. But the financial markets and the economy know how much credit is needed. And so what happens is if you had easy money conditions, which is a good way to describe it, there's always speculators out there who will notice something and then it becomes a speculative item. And so where their theory may have been working in the 70s when they pushed the credit out and commodities were the speculative item and inflation went up and you had some strong economic numbers, but that was just coincidental. So, and they can't quit, and they cannot see their own error. Now, the other stage of blunder in policy making is they assume that there is such a thing as a national economy, that a wise central banker, by manipulating interest rates and the purchasing power of currency, can in turn manage the economy. But nowhere where in the world is there one economy that's isolated from another. We'll just take a look at Canada, for example, on a border 4,000 miles long with the most powerful economy in the world. So, and then, okay, then let's look at one that really is isolated, like Iceland. But in 2008, its financial markets were intimate with the rest of the world, and they took a horrendous hit. So the two concepts of intrusion, one that credit expansion pushes business, is an error, and the other one is that there is a national economy to be managed. There's no such thing as a discrete national economy. It's hopeless. So, Frank, it's a good question, and it's one would say in historical terms, a magnificent blunders by policymakers who are unable to see their own errors. But will they give up power? No. So here's what you have happened is the availability of credit and people buying so many bonds, not just driven interest rates down to zero, but negative. But I'm going to do a study on this because I've had it, well, for 30 years now, the real rate of interest during a boom and in a bubble. The real rate is where you take the nominal rate of interest and adjust it by the rate of consumer price inflation. And on some of these great bubbles in the past, you have gone to negative interest rates relative to inflation. And then when the bubble bursts, then the real rates go up, and they go up hugely. The typical increase has been 12 percentage points, which really is a tremendous hit to the credit markets, but it's Mother Nature's way of ending the abuse of credit, otherwise known as the new finance. And the other one here is that the Dutch in the 1600s, Holland was Amsterdam was the financial capital of the world, and their phrase for easy credit conditions was easy credit, but they rounded that off by when you went into a very harsh bust and credit disappeared, they called it diseased credit, which is a very elegant phrasing going from in a boom easy credit to the contraction where you have diseased credit. And whether it's negative interest rates as adjusted for inflation, or in this case, negative interest rates nominal, I still think that when it fails, it's going to be dramatic and a great bond revulsion, and you'll have some bond prices going to zero and a tremendous markdown in bond prices and a tremendous rise in interest rates. And as I said, the typical increase in real rates has been 12 percentage points, which is some kind of a nightmare. I'm not looking forward to it, but in an academic sense, we'll be watching for it.
We'll have more with Bob Hoye right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Bob Hoye. Bob, the economic markets in India are taking a huge hit. Pakistan was devastated recently. Earlier in the year, it was Argentina and Turkey, and I haven't heard that their problems have been fixed. Are these roosters going to come to roost sometime soon in our backyard?
Chickens coming home to roost, yeah.
I call them roosters because they're making noise. They're squawking hard.
But yeah, I think the sky is going to darken as the chickens are coming home to roost.
The buzzards.
Yeah. We should look at, here's another one that all of their central planning and intrusion haven't been able to eliminate, and that's your seasonal moves. Let's just round it out to the second quarter. So here we were, and I've referred to it as dismal December, where crude oil was dropping down and the stock market was hit. The senior indexes were down 20%. Some of the big stocks were down 40 to 50%. It was very unpleasant. So December 26th, we got the sequential buy on crude oil and on the stock market. And then, of course, the next thing you do is, okay, how long is it going to go up? Well, how long does it typically go up? It goes up into the second quarter, somewhere between March and June, when you can have highs. So let's look at the history of great financial bubbles, of which we are in the biggest ever in history. And as they occurred, focused in when London was the financial capital of the world, and these go back to the South Sea bubble of 1720, when its high was in late June of that infamous year. And then the other bubble, 1772, 1825, 1873, and 1929. In London, the big speculation reached its best, its peak, in May or June of the year. And then in each instance, the stock market dithered around in the summer and then found no bids in the fall and crashed down in the fall, and with typically the worst in late October, and then a bit of a rebound, and then the lows would be tested in November of the year. So it's really methodical. Now, there was one exception, and that was the 1825 bubble, which was a huge one, and it was distressed right through until Christmas. So this is what we used last year to say that if there was a liquidity problem discovered in the fall, that it could last as late as Christmas, which it did. And as I said, we got the buy on December 26th. So here we are. We've got very positive vibrations out there. And the stock market, as we recite, is extremely high valuation relative to wages or relative to GDP, even higher than reached in 2007. Now, we also mentioned the 2007 market as having an unpleasant result, but it was a great bull market and reached all the excesses, did the bells and whistles and all that sort of stuff, and then had a severe hit. And the establishment did say that it was the worst calamity since the 1930s. But the one thing that was missing with that 2007 bubble was that there wasn't a hot new issue market of, as they call them these days, IPOs, initial public offerings. Well, we have had a fabulous new issue market, and that was also the big deal in London in 1720. I think one historian pointed out there was more than 400 new issues of stocks floated. So, anyways, it looks like this big speculative bubble, which had a peak in January 2018 and is having a higher high now on the senior indexes, because the world is buying the Dow Jones and the S&P because you got your big companies there and more liquidity. But if you look at the broad market, like the New York Stock Exchange Composite, that high was set in January 2018. And if you look at the World Stock Index without New York in it, and that index also set its high in January. So whatever it is, the market is, you could say it's up when it should be, the right season, and the credit markets are beginning to change, making us, we'll come out with an alert once they do change.
We'll have more with Bob Hoye right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Gold has had a recent breakout. Is that going to continue?
Oh, yeah. I like gold for the longer term. But it got super oversold in late September, early October last year, and then tested that low in November. We prefer to trade in gold stocks, and because you get better leverage that way. And so our buy on gold stocks was November 1st into weakness, and then there was a secondary low in the middle of November. So we've had a good rally out of it, but the action in gold stocks is getting a little overdone, and also we're watching gold itself for speculative excesses, technical excesses. And then a couple of weeks ago, we're looking at the gold-silver ratio, in which it goes up. When it goes up, it begins to warn of potential problems in the financial markets. And it was rising quite steadily and got a little overdone. So we thought that there could be some volatility in the gold-silver ratio, and it came in, where silver stocks and silver had been quite depressed. You got a fabulous rally out of it, and really that's just since late May. So there's been a good rally in silver. So now we're watching for gold, definitely, because that's our favorite, for technical excesses. And it looks, and this is just intuition, it looks like silver could be, and the silver stocks could be soon approaching technical excesses, which our readers and subscribers, of course, will be advised on. So there's opportunity coming up here, but what we're concerned about, Jim, is that there could be another discovery of a liquidity problem in the fall. So we wouldn't buy gold or silver stocks at these levels and would await further buying to opportunity somewhere later in the year. So, because you got seasonality in these things. You got often crude oil will settle low in December, January, and copper often sets a low in November, December, and lumber can often set the low in October. So, with industrial commodities going down, that's not friendly for junk bonds or most of the markets. They trade up and down with industrial commodities. So we're watching those as well.
Bob, thank you so much for chatting with us today.
Jim, it's a pleasure, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, like our friend Frank in Belgium did, you can send them to info@howestreet.com. By the way, Frank always signs his letters mit Vrenji Deliki Groten, and I just went to Google Translate, and it means yours sincerely.
Good one.
So, mit Vrendelike Groten to everybody. Have a great weekend. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.